Hello traders, Gary Wagner here. It's approximately 10:30 in Honolulu, Hawaii, making it 3:30 in New York City. It is the 28th day of March, Wednesday, 2012, and this is the daily report for gold and silver. Under strong pressure, I do have the precious metals complex lower this morning. We have gold currently trading off of the lows, but currently down about $19, as you can see, $16.62, $16.63. We have silver off about 50 cents on the day, $32.04, $32.03 in that area, and that's down about 1.72%. Platinum down $18, palladium down about $9. Now, we have the crude oil market lower this morning, but it's still only down about $2 at 105.49, and pressure also on the equities markets, currently trading off 71 points. Dow Jones Industrial Average 13,126. Now, there can be no doubt this correction at this particular moment took many traders off guard. It was an unexpected move to happen in the rate or as quick as it did. But when we take a look at it, we can see that in terms of an Elliott wave count at least, it falls within certain guidelines and absolutely does make some sense. And here's what I'm looking at. 360-minute Henkin chart. This is the chart, of course, we've been using for our Elliott wave count. We take a look from the top of 5, and we get this winding down, this ABC, then D, and then E, which I believe terminated this correction. We then went into our impulse phase. This is going to be an intermediate wave 3, which is going to be composed of a minor count. And the minor count is 1. I believe that this is 2. And then we are currently entering wave 3 minor of intermediate 3. And why do I believe that? Well, when we take a look at a Fibonacci retracement, and I'm simply putting the retracement from the beginning of this rally, 1628 or so, all the way to the top, 1697, this is where it stalled. What you can really see, what's quite evident, is when we do a 61% retracement, there can be no doubt that it absolutely matches the low precisely. For that reason, and because silver tends to follow gold, for those that entered the silver market the other day, I felt that this would be an opportunity to dollar cost average. In terms of our gold position, well, we're still in at an average price of $16.50. Market's trading at $16.63. And it is my belief that we have probably weathered this corrective wave 2. Now, traders, there is, in fact, I believe, a silver lining to this dark cloud that we're witnessing currently in the precious metals markets, this correction. What is that? Well, in Elliott wave forecasting, the one wave that we really cannot forecast adequately is wave 1. Wave 1 is used as a benchmark for all of the subsequent waves. One of the golden rules of Elliott wave theory is that wave 3 cannot be the smallest of any of the impulse waves. What does that mean for us? What that means is if this follows that theory, wave 3 would have to be at least the size of wave 1. And what does that do for us? Well, it gives us a pretty eloquent benchmark to look at in terms of where wave 3 should go to. And on a minimal basis, meaning if it's equal to 1, we should see the gold market surpass 1700, go towards 1710, 1720 in that area. That would be a typical 100% move. We can also look at the possibility, and what I'm going to do is to put up a Fibonacci extension, and if it moves beyond that, and what I'm doing is simply marking the high and the low, and then taking it to the beginning. And as you can see, it looks at 1724 as a 100% move of wave 1. However, as you know, In Elliott wave theory, wave 3 is typically larger than wave 1. In many underlying stocks and equities, it's going to be the largest of the impulse wave. 5 tends to be in gold, but a move of 123% would take us to 1740. 1750 is 138% extension of wave 1. So traders, what does that mean for silver? We're looking at some very, very short-term studies. On the right-hand side, we have a Japanese average chart, 60 minutes, a 1-hour chart, and a 2-hour chart currently in just straight candlestick format. And the first chart is going to be the 2-hour chart. And what I'm noticing here is a candlestick that is very, very interesting because it can signal a potential bottom. And that is this candlestick right in here, which is very, very hammer-like. Now, the hammer is really only one indication of a potential bottom. The other thing that I'm looking at is, just as in gold, we've run a Fibonacci retracement from the beginning of this rally to $33. And as you can see, our 61% retracement falls at 31.89, almost 32. And you can see that although the low is below that point of this hammer, the real bodies are not. So this would be a valid place to look for a potential bottom in the market. There's no doubt that the jury is still out, but I believe that the evidence is absolutely building. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.